Hello everyone, welcome back to Forex Signals TV. I'm Shane Vernier, market analyst at Forex Signals and howtotrade.com. In this video, analyst Connor Woods and I are going to give you a crash course in range trading. By the end credits, you'll be up to speed on the basics and you'll know how to actually execute a range trade in the live market. All right, first things first. Before we move on to the ins and outs of range trading, we must first grasp the range concept. A range develops when an asset is priced between a distinct lower and upper extreme for a given period of time. In doing so, a technical area becomes evident between the relative high and low price points. This area is known as the trading range. So what exactly is range trading? By definition, range trading is the act of buying and selling an asset that has oscillated within a defined technical zone for a period of time. The objective is simple: profit from price rejecting from the outer limits of the range itself. To accomplish this goal, one sells the upper bounds and buys the lower bounds of the range. It is that easy. Now, before we dive into how to execute a range trade in the live market, it's important to understand the guiding tenets of the strategy. All range trading strategies make three foundational assumptions. Number one, there are only two possible directions of market movement. Number two, the market is in constant motion. And number three, the market forms its range daily. First, the market has only two possible directions of movement, up or down. Price action either rises or falls with respect to the numbers of buyers and sellers in the market. This presents the trader with the 50-50 paradox. Now, under the 50-50 paradox, if we buy or sell the market randomly, price will theoretically move in our favor 50% of the time. Thus, random trades are profitable, assuming a winning percentage above 50% and a risk reward greater than or equal to 1-to-1. Now that's where range trading comes in. To execute a range trade, we have a finite set of market entry points. We simply sell at the top of the range and buy the bottom. In this way, our entries are precise and should be able to conquer randomness and beat the 50-50 paradox. Essentially, we define a range, locate our entry, align risk to reward to a minimum of 1-to-1, and a positive expectancy trade is constructed. Secondly, the market is in constant motion. As long as the market is open, price action ebbs and flows as participants interact with one another. It's in this movement that ranges are created and opportunities arise. Now, it's important to acknowledge that just because a market is moving does not mean a trend is present. Price action frequently settles down or trades within an established periodic high and low value. These are the types of markets range traders seek to engage. Lastly, the market forms its trading range daily. Between the market's open and its close, a specific high and low price points are set. It's between these levels that the session's daily trading range is established. Now, while there may be smaller intraday ranges created during a trading session, the daily range is perhaps the most basic and frequently referenced range in all of technical analysis. All right, enough background and theory. Let's head over to the trading lab and join Connor Woods for a look at how to execute a real-world range trading strategy.
So let's have a look at a few examples of how we can trade within, say, an accumulation phase or a range in play. Generally speaking, people tend to, use their concepts on trending markets. That tends to be the more favorable way. But you can use these sorts of concepts that I'm going to show you on a range play, accumulation play, as well as a trending play. So firstly, what we want to do is we want to identify this trading range that we're in at the moment. We're on the 4-hour chart, but we can do it on any chart, on any time frame. This is just one particular example that I've found. Now, ideally speaking, if we want to identify it as an accumulation or range play, we want to see that sideways price action coming into play with at least two touches of either side. And you can see we've got that here after a snap to the upside. So we simply draw our trend lines in, the top and the bottom. And the general concept is, of course, we want to sell the market at the high of the range and buy the market at the low of the range. Now, there's some classic market manipulation which can go on here. When you think about how long this market's been stuck in that range, if you was looking at it from a retail trader's perspective, if you was looking to sell the market, you'd probably have your stop loss just above the range. And if you was looking to buy the market, you'd have your stop loss just below the range. So what I notice here, and what I normally mark this as, is clear liquidity in the markets. Now, by liquidity, I mean market makers in the market can easily come and target these levels to flush out the highs and the lows, flush out the retail traders out of the market before moving in the desired direction. So one way we can trade this range is by looking for a fake out of the range. Now, a fake out will be defined to me as something where we see the market trade into the range, but we actually get a wick above it and we close below. That would be number one. That could be the first way we can trade it. Number two would be if we just use maybe demand and supply zones within that range. So as you can see, what we have here is look for any previous bearish pressure before an impulsive move to the upside or the downside. This would be a demand zone example because we've had the last piece of bearish pressure before a move to the upside, and we can see that we're at the bottom of that range because if we can use Fibonacci levels, and we can see that roughly, we're in the bottom of this range around this 61 and 78.6% level of this range. Therefore, this would be a potentially good area to buy from. Where would we target? The top of the range. So if we, for example, we were looking to have a long position which targeted the top of the range, generally speaking, stop loss placement can be at the bottom of the demand zone or below the range, depending on your risk tolerance. But even if it was below the range, that would be a 2-to-1 risk reward trade. Let's see how this one plays out. So you can see that we carried on trading. We had to wait a bit of time because we're trading within that range play. You have to expect that. But you can actually see what happened here. We come and took our take profits. Now that's not it. That's not it over, because what you'll notice is that's when we can use scenario number 2, where we can get that liquidity play coming in. So this is scenario number 1, where we had a demand zone or a supply zone within the range. So scenario number 2 would be to look for a fake out. That would be the ideal scenario. So what happened here? We see the market trading, and then what you'll notice is we got a potential breakout above the range, but look where this candle actually closed. It closed within the range. So here this cross stood for liquidity that was waiting to be taken. Now this is liquidity which is taken. This is a fake out. This essentially means that all of these stop losses that were sitting above this high, and also the buy stops as well, have been triggered and taken out. So liquidity taken. Now, an aggressive way in which you could trade this is as soon as we get that wick above the range or below the range, and we get a closure below that we see here, that's when we can enter the market. And essentially, we could go short at the upper end of this range with a stop loss just above that wick. And again, we can target the bottom of the range. And if you actually have a look what happens with this trade, boom, straight away, we got a 5.26 risk reward trade in pretty much 2 candles. And then, of course, we have this liquidity sitting below here. No, we didn't quite get a wick. We actually got a full body candle closure below here. But what you can actually see when you play it through again is we actually start to then trade back within the range. And it isn't until we have both sides of the market flushed out before we get a generic move to the top side, which you can see start to play through very shortly. So they're the ways that we can use this range play and accumulation play. So we can use demand and supply within range, targeting upper or lower parts of the range, or preferably wait for the fake out, which basically stands for the liquidity grab, and then a move in the other direction, again targeting the lows or the highs, or the upper or the lower part of the range. So they're the really, clear ways that we can actually use these accumulation phases or these range plays or these range phases within markets, and it can be used on any time frame. It's really quick to learn, and we can use that throughout our trading journey.
Does range trading sound like the strategy for you? If so, you're not alone. There are legions of market professionals that swear by the effectiveness of range trading. Of course, if you're going to be a winner, you must have the 3 Ds: desire, drive, and discipline. To learn more trading strategies, feel free to check out the Forex Signals and How to Trade trading rooms. There, you'll find exciting new features such as live squawk and the community trade idea breakdown. Until then, leave a comment below, follow us on the socials, and we'll see you at our next live stream.